are we still kind of pursuing this from a number standpoint, or have you gotten to a point where you're going, okay, I need to really make sure the numbers are working well in case over my 1 month closing period and my 1 month or 2 month rehab, I'm making sure that I don't get another bump by the Fed where my numbers are now non-existent.
Right. Yeah. So there's a few things there. In an environment like today's with the Fed increasing rates, you do have to be more strict on your numbers. You've got to know your numbers better because margins are thinner. Back 2, 3, 5 years ago, really from 2010 to or 2012 to almost 2020, there was more cash flow to be had, almost an underpricing, if you will, of the real true value of the properties, even though at the time we thought, golly, this is so expensive. The housing market's so hot. There was more gap in your margin. So you had more space in your margin. Now that it's tighter, you want to be more strict on your numbers.
Right.
And what I mean by that is if you're going to have a 7% interest rate or an 8% interest rate, that's going to cut into your cash flow. So your cash flow is going to go down. So it is still focused on the numbers, but you have to have a better idea of the numbers, and you've got to make reasonable predictions for the future, right? So nobody's got a crystal ball, so you got to make some predictions. So one would be, I want to say it's December 4th that the Fed is meeting again. And they have signaled, they've said some things foreshadowing or forecasting what they're going to do in the future. Previously, they've said, hey, the CPI inflation numbers are still bad. We're going to be aggressive. That means a 3/4 point or a 75 basis point increase.
Right.
Now it looks like they're saying we're moving in the right direction. So it could just be a 1/4 point.
Yeah.
So take that with a grain of salt, though, that the Fed's numbers don't directly impact mortgage rates. In fact, when they increased 75 basis points, mortgage rates that day went down, which is really odd. And so they're not directly correlated, but they are going to move in the same direction over time. So that's one piece that's going to affect you as far as making predictions about what's going to happen. So they're only going to increase it if they do in beginning of December. Then you got to figure out when's their next meeting. So what's my total lead time? And your worst case scenario is probably if they do a quarter now, worst case, they do 3 quarters later, because that's the most they've ever done. So that's 1 point. All right. So you got a 1 point buffer. So you're evaluating your risk, the likelihood and the magnitude of your risk. So that's one piece. The other is previously you could really look at properties only through the lens of cash flow. So if you say, I've got a 15% cash on cash return, that's really good. I'm making 15% on my money, right? But in an environment like this, it's helpful to have a more holistic picture of what the return on your property is going to be. Because even if you're comparing it to other investment channels like an index or the stock market or bonds or mutual funds, those things are going to say we output X%, right? Or historically, you could make a conclusion that you can expect X% from those. Now with real estate, we've essentially used cash on cash return in the past to say, this is my return, but that's really only one piece of your return. That's just the cash that you see in. That doesn't include appreciation, debt pay down, and or your tax hedge. And so one of the ways that I evaluate this is through through the total return on investment calculator. Have you seen that? Would it be helpful to look at it?
It probably would be. I think.
Okay.
I feel like we have, but I don't recall.
Well, yeah, let's look at it. So this right here is essentially you put in numbers for your property, or if you're looking at something more generally, put in reasonable numbers, and it's going to output what your total return is. All right, so let's just do this, and let's hide these bad boys so that we don't know what's coming. Okay, so let's say we're buying $100,000 property, and we're putting $20,000 down. We got $3,000 of closing costs, and let's say our cash flow is pretty low. In fact, let's even bump it down to 150. Okay, and our loan rate, let's say it's pretty aggressive, 8%. Our appreciation, 5% is really reasonable. That's likely in the markets that we're investing in for cash flow. That's very reasonable. Now, the larger metros like the Bay Area, Austin, etc., those are declining in price right now. That decline in price doesn't mean it's always going to decline. It just means that it's correcting right now. But in smaller metro areas, 100,000 people, 200,000 people, that's not the case. In fact, I recently sent over an article in Slack and posted on social media about the evaluation that people are predicting, the smart people, the economists that are predicting home price rise or drops. And in all of these smaller metros, they're going up 3-4%, right? And so that's over the next year. And so for yearly appreciation, you have two functions of it. Appreciation has two core drivers. One is the true intrinsic value of the property, how valuable it is because of the market that it's in or the property specifics itself. That going up is usually the main indicator that we think of. The other piece is the cost of money or the value of the dollar. And so right now, inflation's at 7.7%, I believe is the most recent output. And so if your market even just becomes 1 or 2% more valuable, this is going to be at 10%, something really, just because of inflation alone. And so let's just say that it's 7%. I don't think that's unreasonable. We could do 5, we could do 10. Your loan amount's 30, you got this rate. We're not going to worry about the cost segregation right now, but let's just see what that outputs. 55%. That's your total return. So if you're comparing it to some other investing mechanism like mutual funds, bonds, stocks, venture capital, et cetera, this is the number you actually want to compare. And it's made up of 4 functions. Your cash on cash return, 7.83% cash on cash is not very good for a turnkey. Generally, you're looking for 10 to 20% on turnkeys. But right now you might say, well, if this goes up 5%, I just made $5,000 out of 23, right? That's over 20%. So your appreciation is actually going up 7%. It's actually 30.43%. It's not just 7%, it's 7% of $100,000. So you made $7,000 divided by 23. That comes out to 30%. Your debt pay down is about 3%, kind of marginal. And then because your cash flow is lower, your tax shelter is actually higher. So this number represents not just the total amount that's tax deductible, but the real money in your pocket related to that. So for example, if you earned $10,000 or you wrote off $10,000 worth of goods, services, business expenses, in a 40% tax bracket, that represents $4,000 of actual money in your pocket. So that's what this number is contributing to. Because your rate is so high, this number is going to be driven by your rate and your property value, because it also includes your debt service, right? So right now, if we actually bump this to 10%, which I don't think is unreasonable, you're looking at a 70% return, mostly in appreciation. But if we bumped it down to, say, 5% return, and let's say your cash flow is, you can find something that's 250. You can play around this. Maybe you're at 6%. See, the rate actually in your 12 months, the rate doesn't make a huge difference. What it changes primarily is your tax hedge versus your debt pay down, which makes sense because your tax hedge, one of the core functions of that is interest, right? It's your debt service. So if you're not paying it, if you're not making it here on your debt pay down, you're making it here. So that's all in 1 year. In 5 years, if we take those exact same numbers and we push them over here, in 5 years, you can make 250%. That's not exactly a bad situation, right? Because likely, now you can't predict the future 100%, but likely what's going to happen is sometime within this 5-year time frame, rates are going to go back down, right? There's been whisperings and rumors that, maybe we'll be back in the 4s in the 2025 time period, maybe 2024, late 2024. And so when you refinance, you're going to be able to keep all of this stuff the same, and then this is going down to 4%, right? And it's going to bring your cash flow probably up to that. So these numbers shift around. You're getting a little bit less on this end and more on the cash side of things. So the reason that I bring all this up is because in an environment where your cash on cash return is really thin, and that's been your primary evaluation metric for your properties, you need to be able to adjust, and you need to be able to better understand the entire return on a property. Otherwise, if your cash on cash return is 5%, you might say, well, maybe I should invest in index funds. and just get an 8% return in perpetuity or put it into some other investment. And in that case, you would miss out on a lot of the other values of the properties.